It's way too good to be true. Get underlying exposure to the upside of Bitcoin and MSTR while still cashing out monthly income to live off of. When I first heard about this, I thought there's no chance that's real. This is the potential promise offered by MSTY, which is one of these new financial products, an ETF that's built on top of MSTR, which is MicroStrategy stock, or now strategy. So it definitely sounds too good to be true. It looks like a dream. You get monthly yields north of like 60%, which are powered by MSTR's wild volatility swings, and you're still sharing in a percentage of the price appreciation of the underlying MSTR, which is a leveraged play on top of the underlying Bitcoin. So this video is a deep dive into whether this thing is a yield monster or a ticking time bomb that's too good to be true. Because I am not an expert on covered call strategies or ETF income products, so there's a lot of unknown unknowns for me in trying to understand the risks of a fund like this. I see a lot of people saying MSTY is an income generating beast. Put a portion of your stack into that, take monthly dividends, and you can live off of that. And then you can use that as a strategy to never have to sell down your Bitcoin or your MSTR holdings that you want to hold on to long term. Because if you want to live and pay expenses, you're going to have a job or have a different source of income, or you're going to have to sell down your Bitcoin or your MSTR monthly to pay your expenses. But if you have a core nut of Bitcoin or MSTR, and then you have MSTY paying you monthly dividends, then you can use that as a strategy to never sell down your core holdings of Bitcoin. And right now, while Bitcoin's in its adoption phase, its store value phase, that's the name of the game. Stack sats. So I really wanted to understand whether this risk reward scenario of buying MSTY at the expense of holding underlying MSTR or Bitcoin is worth the trade-off. And listen, I'm not talking about the question, will MSTY underperform MSTR? Yes, it will. That's basically a given, since by definition, you're trading long-term upside potential for dividend income. I'm talking about other concerns like specific risks or dramatic underperformance versus the underlying MSTR, or most of all, it's the NAV erosion, net asset value erosion, that I'm concerned about that could turn MSTY from what looks like a genius income strategy into a trap disguised as the dividend machine. So if you're bullish on Bitcoin and MSTR, which for the record, I definitely am, the risks of this strategy are obviously diminished, but I was still left with some concern that the success of the fund depends on a few key assumptions that have to hold true for several years straight, especially if you're planning on holding MSTY as a long-term income play. You want to be able to quit your job and use MSTY as an income stream. You need to know that these assumptions are going to hold true over a long period of time. So I'm openly admitting I'm definitely nothing close to being an expert here. The whole point of this exercise is to share my journey, attempting to understand the risk rewards of MSTY, and to ask others who know more than me to weigh in, tell me whether my analysis seems accurate or whether I'm misunderstanding or missing important details. Or maybe I'm pointing out things that other people haven't thought as deeply about when they just go in thinking, oh, MSTY is just this cash cow, golden goose, and just put all my money in there. So for anyone who's familiar with MSTY, this part's familiar already, but anyone who's not familiar, this is a quick background. MSTY is an ETF that's designed to provide dividend income while maintaining exposure to the share price of MSTR. So by the nature of the strategy, MSTY is subject to limit on potential gains, even if the underlying MSTR appreciates. You're trading appreciation for income. MSTY employs a synthetic covered call strategy. They sell call options on MSTR. By writing calls, the fund collects options premiums, which serves as the income stream for investors. They collect options premiums, and then they take the profits and deliver them back to investors as dividends. But the strategy caps the potential upside of gains of MSTR. So because it's built on a super volatile stock like MSTR, the significant volatility makes it so the strategy can generate substantial income. For example, the fund's recent payouts equated to an annual yield of 160%. The volatility of MSTR is the key to the potential success of the strategy. That might seem super obvious, but YieldMax, who makes this MSTY product, offers a lot of other similar products built on other securities. TSLY is built on Tesla, NVDY is built on NVDY. And when you look at those, they seem like they've underperformed by a lot. The one-year average return of YieldMax ETFs is negative 43%. So the concern is it's possible that the NAV erosion, the erosion of the net asset value, could become so brutal that it wipes out all the benefits, even of the dividend income, even if you're reinvesting the dividend income. So my understanding is a product like MSTY is successful if the total return, meaning the share price change and the dividends, is positive. But you have to also be careful where those dividends came from. That return has to come from sustainable income generation, not just from them returning your own capital back to you. And I'm going to get deeper into that a little bit later. Quick pause to say, if you're enjoying any of this, please hit the subscribe button, the like button, leave a comment below. It really helps the algorithm, helps the channel. I appreciate it. All right, back to the video. So here's my thesis going into this analysis. I did a bunch of Googling, Reddit, YouTube, and then a bunch of talking to ChatGPT. So my thesis going in is coming from a position of somebody who wants to analyze MSTY and try to figure out whether it makes sense if you're an investor who, A, already holds Bitcoin and MSTR for the long-term upside potential. You want a yield-generating sidecar. You want a way to generate monthly income without relying on capital appreciation and selling down your underlying position. Like I said at the beginning, you want to hold the Bitcoin and the MSTR you already have. You don't want to sell it down to have monthly income. You have to be okay missing out on some of the potential upside gains of Bitcoin and MSTR with a portion of your portfolio in exchange for building that income engine. And you could make an initial investment into MSTY and then start taking the dividends and cash immediately. But personally, my standpoint is make an initial investment and then drip the dividends back into the fund to grow the share base, and then switch to an income strategy to take distributions in cash down the road. Personally, I would also operate this strategy inside a taxable account, because time horizon for me at my age, it's not worth doing this in a tax advantaged account like an IRA and then waiting decades to be able to take the income out. I might as well just hold the underlying Bitcoin or MSTR in the tax advantaged account and just get all the potential appreciation over time if I'm not going to take it out for like 20 years anyways. So for me, this would be being done in a taxable account. So I talked about NAV erosion. Let me explain that more. So NAV is net asset value. And this is a huge part of what I wanted to examine with this analysis to understand whether or not this has the potential to kill the strategy. Like I said, if you're already bullish on Bitcoin and MSTR, I think that wipes out a large majority of the concerns that most people have about a fund like MSTY. Most people, I think, are focused on like the systemic risks to Bitcoin or MSTR. So if that's what you're worried about, you just need to do more homework on Bitcoin and MSTR before you would ever consider an income product built on top of both of them. I'm bullish on Bitcoin and MSTR. I'm not worried about this whole systemic risk piece to those two for the most part. My biggest concern arises from what's the likelihood that the NAV erosion in a fund like MSTY eats away at the capital so much that it disguises that there's actually a fundamental flaw in the strategy, and it severely damages the real returns, even when they still look impressive on paper. And I'll show examples of that later with, like I said, other YieldMax products that returns look crazy impressive on paper, but the story is not at all what it seems. So NAV erosion means the underlying value of each share slowly declining over time. This can happen even when you're collecting big monthly payouts, because the fund is generating the yield by selling the upside. And when MSTR goes up, you don't fully benefit as a MSTY holder. But when MSTR goes down, you still eat the loss. So over time, it can lead to a slow grind lower in the share price. And especially if MSTR were to like trade sideways or dip for extended periods, you're going to see the NAV just drop off a cliff. So even if you're collecting income and dividends, your principal is shrinking underneath, and it can be shrinking so much that it wipes out the entire real gains. A real example would look like this. NAV is dropping 7% a month. Each month, you're getting a big dividend, which looks great. You may be reinvesting the dividends and you're using them to buy more shares, which feels good, but each new share is worth less and less. So your total portfolio value isn't going up, even though the share count is going up. It's like reinvesting into a melting ice cube. And it feels super deceptive because you're getting big dividends. So if you're reinvesting, it feels like growth. Or if you're taking the cash dividends, it feels good, but you're gradually owning more and more of this shrinking asset, and the dividend payouts are going to get smaller and smaller. And there's another really important twist you have to understand about a fund like this, which is that the dividends they're paying you might just be giving you back your own money. So if the fund pays out more in a monthly dividend than it earns in options premiums, it pays the difference from capital. You're getting your own principal handed back to you, and they're labeling it as a dividend. And then if you're reinvesting, you're investing your own money into an asset that's worth less. You're not compounding, you're cannibalizing yourself. You're trading long-term capital for short-term cash flow. It looks like growth, but it's a slow liquidation in disguise. So an example is TSLY, which is a YieldMax ETF focused on generating dividend income from Tesla stock using a comparable option strategy. So it had a 19.8% total return over the past year, but it experienced NAV decline of like 46%. So you see the trade-off between the high income, but the NAV erosion. And that's my main concern with MSTY. A YieldMax product like this is successful if the total return is positive and the return is coming from actual yield, not returning your own capital, and the NAV erosion isn't permanent or accelerating, and the yield can continue. So obviously the dividends have to be more than the price loss, but most of all, you want to see that the dividends are more than the price loss and sustainable yield and the resilience of the NAV. I'm going to show on screen the results of 4 YieldMax products over the last year. What you can see is that on paper, the returns and the yields look eye-popping. MSTY, 152%. TSLY, 121%. CONY, which is built on Coinbase stock, 207% yield. But the one-year price return was negative 72%. So the NAV is bleeding, and I'll tell you why the numbers seem super deceptive in just a second. So if you're taking dividends in cash and the total return on one of these funds is still positive, then yeah, they worked out over the past year. But that still doesn't mean they're sustainable. The NAVs on each of these are melting. And if it keeps happening, the yield won't even matter. Your principal will just evaporate. And one of the biggest concerns, much of the yield might just be return of capital. If the fund pays out more than it earns, like I said, they're returning your own money to you and labeling it as a dividend, which props up the yield number like crazy, but it masks tremendous NAV decay. Also, this is the last 12 months, and past performance obviously does not equal future yield. So if the underlying stocks, Tesla, MSTR, COIN, if those cool off, if the options premiums shrink, or if the volatility drops, then the yields collapse. You're bag holding something that's bleeding NAV, the upside is capped, and there's basically no income left. So these funds are successful mostly in the short term. Long term is still very unproven. And without persistent high volatility, I'll come back to that, and strong premiums, the funds could turn from yield machines into slow motion train wrecks. My concern, again, is that these funds can work, but they're skating on really thin ice. If anything about the underlying assumptions or the environment shifts, the NAV bleed overwhelms the income. So let me come back to what I said, the CONY ETF YieldMax product, that's option strategy income ETF built on top of Coin, which is Coinbase's stock. On paper, it delivered a 207% yield. It had a one-year price return of negative 72%. So it still had a 135% total return, right? Let me tell you why I said that's super deceptive. So first of all, I asked ChatGPT to do a deep research on the last 12 months of the distribution for MSTY, TSLY, NVDY, and CONY. So those are the YieldMax products on MSTR, Tesla, NVIDIA, and Coinbase. I asked ChatGPT to determine how much of the distribution is actual net option income versus how much of it is return of capital. It's very long deep dive research that it did, which I'll post like as a separate article on X, and then I'll link it in the description of this video. But here's the main takeaway. From the official YieldMax notices, it confirms that these ETFs' super high yields are often not fully supported by true net earnings. Return of capital is a major component of the distributions, especially the Tesla one, the NVIDIA one, the Coinbase one. Those funds are paying out cash dividends that's more than what they earned in the options premiums. So they're liquidating a portion of the assets to fund the dividend. YieldMax straight up warns you that this might happen. And the crazy distribution rates, which look like over 100% annualized, you should not conflate that with actual investment income or with total return. It's your own capital coming back to you. The Coinbase one is by far the worst. CONY clearly looks like an unsustainable extreme of a fund like this. Over the last 12 months, the NAV deteriorated a ton, and the distributions exceeded what the fund earned. Even with dividends reinvested, it lost nearly a third of its value, and the payouts were largely financed by return of capital. Some of the monthly payouts, 70 to 100% of the dividend was return of capital. So I'm talking about these other YieldMax products because I want to illustrate that that's the concern I have with going into MSTY. The yield numbers on paper look crazy good, but what's really going on underneath? So the biggest question here for these purposes is MSTY built different? And going back to the deep research that I just told you that I had ChatGPT do about the last 12 months of dividend payouts from those 4 funds, it looks like there's a big difference between TSLY, NVDY, CONY, and MSTY. Because the MSTY distributions have been much more supported by net options income than others, meaning in most of the months, the payouts were predominantly net investment income. There's much less return of capital going on. So I think basically the whole thesis of this is that this comes down to this reflects the extreme volatility and therefore rich options premiums of MicroStrategy now. MSTY last year paid out over 100% of your initial investment in cash dividends, and it still ended that 12-month period with a share price equal to the start. So you pocketed huge profits and you retained your capital. Or if you reinvested the dividends, you built a share base like crazy, and you didn't see a tremendous NAV erosion that wiped out your real return. The scary part seems like relying on these huge payouts for income is like eating the golden goose. If the underlying stock doesn't keep delivering, the NAV continues to shrink, and that reduces the future income potential. So what I'm thinking here, and maybe this is obvious to everyone else, and I'm just a dum-dum, it took me like 20 minutes of explaining to get to this point, but what I wanted to really understand is part of the thesis here that tech stocks like Tesla and Coinbase can't provide the consistent volatility needed to make the strategy work long term. but MSTR can, because MSTR is fundamentally built different. It's not just a tech stock. It's designed specifically to harvest and provide volatility. It deliberately aims to keep that volatility high going forward because it's a leverage play on top of Bitcoin, which we know already has high price volatility. So if you believe going forward, MSTR will stay elevated, not have a big crash, and it will remain volatile because the big swings equate to juicy options premiums, and you think the volatility of Bitcoin will continue, then MSTY looks a lot less like a trap, like CONY, and it looks much more like this yield optimized volatility farm that you're trying to build. So is this a viable thesis? I'm leaning towards yes, because MSTR, like I said, is Bitcoin leveraged by design. The volatility equates to better yield, and the NAV oscillates instead of just eroding. So if you're reinvesting dividends, you're going to be reinvesting at times at very low points and getting you more shares, and then that's compounding. And then when the price bounces back later, the reinvested shares catch the lift. So I did a simple model with ChatGPT's help saying, okay, if I invest $10,000 today at an approximate share price of $19.85 in MSTY, let's say the strategy is I reinvest the dividends for 3 years to build the share base. And then after that 3 years, I plan on taking cash distributions for the next 3 years. The assumptions built into the model are, let's say MSTR follows historical Bitcoin style price action. So like pump, crash, chop. Therefore, because the NAV is oscillating up and down, the yield fluctuates. So let's say it fluctuates between 3 and 8% monthly, depending on how much price volatility there is. And then the share price of MSTY follows a 3-phase cycle. So year one pumps, after that crashes, and then after that does a sideways chop with some volatility. These are just assumptions that I wanted to see one scenario play out if the next 3 years look somewhat like historical price action in Bitcoin. So the simulated results of the model are if you invested the 10K today, after 3 years of reinvesting the dividends, the portfolio grows to like 70K. Then if you start taking dividends in cash, the following 3 years, you would extract a total of 120K in cash. And the final portfolio has some NAV erosion, but still ends up at 57,000. So the total return over a 6-year period of an initial investment of $10,000 with reinvesting the dividends for the first 3 years, the total income in years 4 through 6 is 123 grand, and the final portfolio value is 57 grand. So the combined return is 180,000, which looks amazing. Again, like I said, everything about these products on paper looks great, but my ongoing concerns are rooted in the assumptions that have to hold true to make all the above happen. Like I said, that's a 6-year period. So the assumptions that have to hold true for this to work, MSTR has to stay volatile and elevated, so price can't crash like crazy, and the volatility itself is essential for the high options premium. The MSTR options market has to stay healthy, so you can't see liquidity dry up or the IV crash. The NAV can't collapse and stay down, so a big drop in MSTR could lead to a bigger drop in NAV for MSTY. You can't panic during the drawdowns, so if MSTR dumps and the NAV of MSTY crashes, if you're bullish on the strategy, it's going to feel good to reinvest the dividends at a lower share price. But if you panic, it's going to feel really bad to reinvest into something that's bleeding NAV like crazy. But reinvesting at that low point would be critical for your long-term strategy of compounding more shares. It would also be bad if Bitcoin or MSTR just go straight sideways for years. So if the prices stagnate, then the options premiums are going to shrink and the NAV is going to bleed out. You also need some degree of timing if you're doing this strategy where you reinvest the dividends and then you flip to taking the cash dividends. If you time that poorly and the income extraction starts right before a big downturn, that's bad news. And then you need all those assumptions to stay in your favor for that whole 6-year period. So in my mind, that's the risk. If one of these things breaks, the NAV is going to drop super hard. Everything you've accumulated is now going to be worth way less. And the income that you're counting on is going to dry up. And you can't really recover. Like, unless MSTR has a huge rally, it's hard for MSTY to recover. It's like you're growing a fruit orchard for 3 years, and then a drought hits right in year 4 when you're about to start harvesting the fruit. So what's the bottom line? If MSTR behaves like Bitcoin, and like MSTR has historically behaved since they started their Bitcoin treasury strategy, you have big pumps, violent crashes, and volatility in between. This income engine on MSTY can absolutely work, even if you're doing it in a taxable account. I haven't even talked much about taxes, but obviously they're going to eat into your income if you take the combo of the volatility, and then you do the reinvestment strategy, and then you switch to income mode later. You can take your initial investment and turn it into a yield machine for sure. The concern is a cash cow until it's not. You're saying, I'm going to use Bitcoin and MSTR volatility to grow a yield monster, and then I'm going to milk it But if the volatility or the market structure breaks, the cow could die super quickly. So the whole point of this was just for me to sort of publish my personal deep dive into trying to understand this and understand the risk rewards and the trade-offs and whether or not it makes sense. I would love to know if anybody is learning this alongside me and learned anything from this or has questions about anything from this. Or most of all, if somebody has experience with this, running a real strategy with MSTY, knows more than me, has way more expertise in strategies like this, and wants to weigh in or could tell me what I'm missing. Am I right to be concerned, especially about the NAV erosion piece and basically what I'm getting right or wrong in this analysis? And now there's another product like this, but slightly different, called IMST, which is Bitwise's income ETF built on top of MSTR. And that's going to be apparently operated slightly differently. So I'm interested in that one too. It just launched like a week ago, so there's not a lot of historical data on it yet. But based on who's running it at Bitwise and the team there, some people think that it may be run in like a smarter, more intentional, more interesting way than the way MSTY runs its synthetic call option strategy. So this video is a departure from normally I make like Bitcoin maxi content. I haven't even made an MSTR video ever before, but I was just doing this deep dive into this to better understand it for myself. And I was like, there's really no reason why I can't just publish this, because I'm sure other people might be interested in learning the same thing. So if you find it interesting, or if you hate this type of content, whatever, just tell me in the comments. And if you prefer the straight up Bitcoin maxi content, I just did what I think is an interesting video on how the global financial system might be changing and why the 60-40 equity bond portfolio might be dying and the era of US Treasuries as the global reserve asset might be dying and why, you guessed it, Bitcoin might be the neutral global reserve asset of the future. You can watch that video right here. Never forget, Bitcoin's inevitable.